I'd just like to briefly introduce our panelists that are here today. First off, I'd like to thank the Korea Economic Institute for co-presenting this program with us. Tom Byrne, our new president, was just up in DC about a month ago on the same topic. So we're happy to update everyone on this topic here with the Fed meeting coming up later this week. Don Manzullo, seated next to our president, is the CEO and president of the Korea Economic Institute. For 20 years, Congressman Manzullo represented the 16th District of Illinois in the House of Representatives, serving on foreign affairs, financial service, and small business committees. Next up is Dr. Alex Pollock. He is the resident fellow at the American Enterprise Institute, where he works on policy issues relating to mortgage finance banking, the Federal Reserve, government-sponsored enterprises, retirement finance, corporate governance, and the role of uncertainty and risk in financial systems. Immediately before joining AEI, Dr. Pollock was the president and CEO of the Federal Home Loan Bank of Chicago from 1991 to 2004. And last but not least, Marc Stocker. He's a senior economist at the World Bank's Prospect Group. He's actually representing Dr. Ayan Kosei, who could not make it. Ayan Kosei is the director of the Prospects Group at the World Bank. And Marc is one of the lead authors of the Global Economic Prospects Report. It presents twice a year the institution's macroeconomic forecasts and analysis. Prior to joining the World Bank in 2013, Marc has held various positions in academia, central banking, the private sector, and international institutions. And now I will hand it over to our new president, Tom Byrne. Thank you.
Thanks, Nikki. Can you? It's time to. Right, I just wanted to thank everyone for coming today, and also thank the panelists, some of them who were challenged by the weather, the dense fog, which I understand is not related to global warming, or at least what I read yesterday, or El Nino, but something called the Arctic vortex, or something like that, some weather pattern that we're having. At any rate, again, this is actually the second leg of this this discussion that we're having, and there's four of us here. We have a wide range of views, and I'm sure the views will be articulated very strongly. Perhaps I should mention the Korea Society is private. It is nonpartisan. Related to that, we maybe could have had a fifth chair here if we could have squeezed it on to give the Fed's view on this whole thing, although it's hard for anyone from the Fed to talk right before an open market committee meeting. At any rate, nothing related to today's program, but reading the FT today, the Data Watch thing, I thought this was an amazing chart that was put up on the front page, and it just shows how South Korea's convergence actually with the advanced income countries in terms of per capita GDP growth, how it's over the past 25 years, it's performed better than anyone else. And I should say and that's going through two crises, the 97 crisis and the 2008 crisis. A calculation I did about a year or two ago would be that South Korea's per capita GDP would catch up with France's by the time President Pollock leaves the Blue House. At any rate, let's turn to the matter at hand. So the Fed is about to, well, we'll have a meeting tomorrow and Wednesday. And there's a wide expectation among market analysts and economists that perhaps now the Fed will finally move. So let me turn to Alex first. Alex, in your opinion, what is the Fed likely to announce later this week? I believe it's on Wednesday. And why has it taken the Fed so long to raise interest rates? What have they been looking at, or what have they been waiting for?
Thanks, Tom, and thanks for having me. Well, like everyone else, I think we'll see a 0.25% rise in the Fed's policy rate. That is basically a trivial amount in and of itself, bringing us to only an amazingly low level of short-term policy rates instead of a completely incredibly low level. If we could imagine 1/4 basis point increases once a quarter for 2 years, that still only takes you to 2%, which not very many years ago, a lot of us would have predicted was an impossibly low level of interest rates. So the Fed's action to manipulate interest rates lower continues. And that will still be a very much of a manipulation in place after the expected 1/4% rise. I think they would find it very hard not to do the 1/4% increase Wednesday because they've spent so long building up expectations and politically forming a consensus. But even more importantly, not to do it now, having done that, would be an obvious admission that they didn't really know what was going on, as of course they don't. My view is that you have to be very sympathetic with the Fed because in their heart of hearts, they know that they don't really know what's going on or how complex economies, which are globalized, work, but they still have to pretend that they do, and they still have to make decisions. On a bigger issue, you might ask yourself, why do we want a committee of economists trying to set interest rates in the first place and trying to divide economic outcomes between sectors and between debtors and creditors? A tough question. We know that central planning doesn't work and price fixing doesn't work, but we have a notable price fixing committee. However you may come out on that one, so we get the 1/4%, not very much. And just to spend 1 minute on why it's taken so long, one of the Fed's goals has been to create a wealth effect by causing asset prices to inflate with extraordinarily low, close to zero rates. And in this, until recently, they have greatly succeeded. House prices are still booming, of course. Energy prices have now dropped like a rock, a forecast which was not made by the Fed. In fact, their stress test for 2015 suggested the stress would be rising oil prices. Yeah, so they got that one quite wrong. But as we all know, the collapse in oil prices and other commodity prices and is now putting tremendous pressure on low quality bond markets. And all of that has been cause for further waiting. But I think the Fed can't afford to admit that it didn't know enough about what was going on, and so it can't wait anymore. Just a final note, of course, the other thing that the very low rates do is to lower the cost of financing the U.S. government deficit. Effectively, the Fed, by buying government debt and government mortgage securities and refinancing it at 1/4%, which is the rate they pay on deposits held with it, is financing the government net at 1/4%. So you're lowering the cost of carrying the deficit, which the Fed doesn't talk about as a goal, but I think has been one of their goals. And even if you go up from 1/4 to 1/2, that's still pretty cheap financing. Thanks.
If the Fed is about to raise interest rates because the economy is strengthening here in the U.S., what on the other side? What are the possible economic or financial complications of this likely liftoff, either domestically or internationally? How do you see this, Alex?
The first thing we've already seen, of course, which is that we've had a very strong dollar and against all currencies, which is already hurting manufacturing, and we have some problems in manufacturing. It's also quite bad for agriculture. Those would be two of the sectors that Don Manzullo used to particularly represent, manufacturing and agriculture. So it may be that we're not getting the increase because of the increasingly strong economy. I think we're getting it because of the internal dynamics of the Fed. But the strong dollar is hugely important in its effects all over the world for emerging countries, for all countries, and in particular for this country. Back in the severe recessions of the mid 1980s, the super strong dollar was one of the biggest factors causing real havoc domestically in the U.S. economy, and it may again. So I think that anybody has to worry about the divergence between other major central banks continuing to expand credit, and if you get a Fed increasing interest rates, the effect on the dollar, and since the dollar is the global currency, the huge effects on trade, and of course one point in particular, which is the increasing unaffordability of all the U.S. dollar denominated debt issued by entities in other countries, in emerging countries in particular.
Well, thanks, Alex. What I forgot to mention is that we intend to talk for about 30 or 40 minutes, meaning there'll be a Q&A period for about 20 minutes. Maybe Nikki mentioned that. But let me turn to Don. Don, what's your perspective on Fed policy and its implications domestically, particularly from your vantage point of having been a congressman, so serving in Washington, D.C. with other congressmen, and then also having served represented constituents out in Illinois? What's the grassroots vantage point of Fed policy?
Well, Tom, I appreciate that very much. When you made this statement, now that the economy is strengthening, the increase in jobs is part-time jobs. We have the lowest labor force now in years. That's the number of people that are actually in the workforce. We have, along with Korea, a huge mismatch in college graduates getting employment. And now we have all these college graduates that are either unemployed or underemployed, trying to pay off $1 trillion in debt, unable to pay their home or buy a home, and often living with their parents. So this is not the rosy scenario that some people think it is, that the economy is that strong. Plus, PMI index for U.S. for the first time in 4 or 5 years is below 50. In Korea, it's been below 50 for 9 months. And so you see a certain contraction going on in manufacturing. And I sat on the Committee of Jurisdiction in the Banking Committee for the Fed, which is on capital market. I'm sorry, for the stock market, which was on capital markets and GSEs. I also chaired the Small Business Committee from 2001 until 2007. And what we saw taking place was, it was really sad. My community banker forecast exactly what was going to happen years and years ago with what were called liar loans, where the Fed actually encouraged loans without having to require a written proof of a person's wages, where both Presidents Bush and Clinton asked the Fannie Mae and Freddie Mac to buy up these securitized mortgage packages, which were, again, many of them were comprised of loans where there had been no proof as to what a person was earning. And you could see this house of cards coming together and then falling. I've been reading Ben Bernanke's book. I'd like to make a quote on there, and I've got a lot of respect for him. He was in the Fed until 2005. Then he left to head up the Council of Economic Advisors. Then he came back, I believe, February 1st of 2006. And Lehman Brothers hit the wall, and he threw everything. He invented everything he could and found every tool he could, but to keep the world from what he perceived as a worldwide run on the banks. So he was cast in a very, very difficult position. But in his book, he says, toward the end of my tenure as chairman, I was asked what had surprised me the most about the financial crisis. The crisis, I said. I did not mean we missed entirely what was going on. We saw, albeit often imperfectly, most of the pieces of the puzzle, but we failed to understand, failed to imagine might be a better phrase, how those pieces would fit together to produce a financial crisis that compared to and arguably surpassed the financial crisis that ushered in the Great Depression. A few people had warned about various risks, but few, if any, economists, or for that matter, policymakers or financial executives, had assembled all the pieces into a coherent whole. In 2000, 2003, and 2005, Congressman Richard Baker, who headed up the Capital Market Subcommittee, had introduced legislation to curb the powers of Freddie Mac and Fannie Mae to buy on the secondary market these mortgage packages, as to which, in most cases, there was no proof of earnings of the person who made the application. And in 3 different votes that came up, it passed the House once, and the other 2 had never really got to the floor. And so there was a group of people who saw something coming, but couldn't piece everything together, which is really what Bernanke said. When I chaired the Small Business Committee, what we saw was when the bank examiners finally got their orders to go after community banks that were giving loans that did not have exact proof of earnings to repay, which were all lines of credit for small businesses and manufacturers, then the manufacturing sector really started hemorrhaging. And so you had all of these pieces that were floating all over the place, such as somebody that busted his knee and the pieces of cartilage are all floating around. Eventually, it would lead to the collapse of the knee on it. So it was an interesting time, and but what it goes to prove is the fact that the Fed really was not listening to the community banker, or to the farmer, or to the manufacturer.
Marc, I won't ask you to defend economists, but maybe we
I will present them bravely.
Sorry. Sorry. I said I won't ask Marc to defend economists, but maybe we could move on to his work at the World Bank. So first question is, what are your general expectations for the effects on markets and risks to investors and borrowers from the beginning of a Fed tightening cycle?
Thanks. So I think at this stage, anything else than a hike on Wednesday would be perceived as a shock by market. As been mentioned previously, this has been built into expectations, which does not mean that it will necessarily go on very smoothly. That probably it's going to be accompanied by episodes of volatility. We've seen it already last week and this week. High yield bond markets are a bit jittery. Currency markets are also moving pretty sharply. But the real question is what is going to happen beyond the decision on Wednesday, and so where rates will go from there onwards over the medium term, and how emerging markets will be affected as a result. So in other words, whether we expect smooth sailing for emerging markets or a perfect storm. This is the title of the paper we just issued. We recommend that you have a look at it. All the material presented here derived from there. So first, I would say that emerging markets have already been in lift-off mode since 2013, the taper tantrum. They've seen a significant increase in credit spreads by more than 150 basis points. Their currencies have depreciated for many, on average by 20%, and stock markets have dropped by 5% in local currency terms. So there has been quite a number of adjustments on the asset price side for emerging markets. So how have conditions evolved since 2013? This is obviously a relevant question to know if we are going to see a super tantrum episode this time. So there are 2 questions. First, on the side of advanced economies, how have conditions developed, and whether this is going to be helpful for emerging markets. And there, things have improved. So if you look at growth rates on average for G4 countries, that is the euro area, US, Japan, and In the UK, growth has doubled since 2013. So this has obviously positive spillover effects for emerging markets in terms of trade, but also in terms of broader confidence and sort of keep risk premia low globally. If you look at the particular situation of the US, labor markets have recovered, have healed quite substantially since the global financial crisis, and the economy as a whole has moved quite a bit as well. So we're still below pre-crisis trends, but the unemployment rate dropped where it has been in previous recoveries, 5%. This is equivalent to what we've seen in the past, and already below rates when the Fed hiked previously. 2014, for example, the Fed started hiking rates when the unemployment rate was at 5.6, and rates were higher. There were 100 basis points at that time. So it has been mentioned that the labor participation in the US has been decreasing, but these are mainly related to demographic trends that the Fed cannot do much about that. So if you look at the employment gap, or the distance to the employment target of the Fed, it's probably making sense that they start hiking today. Given the fact that this hike is happening against the backdrop of a strong domestic economy in the US, I mean, we can argue about the shape of manufacturing, but the broader domestic economy is doing pretty well, and it doesn't reflect negative inflation surprise. So inflation picking up more rapidly than you would expect. So this is positive for emerging markets as such. So it's a real economy-driven rise in interest rate rather than a surprise in the pace of the Fed tightening or by a negative inflation surprise. And the fact that this is good for emerging markets is illustrated here, which shows that when US interest rates rise because of the real economy being relatively robust, then the effect on both stock markets and on industrial activity in emerging markets tend to be positive. So when you have the combination of yields increasing in the US together with stock market returns increasing in the US, subsequently you see that economic developments are relatively positive in emerging markets. Now, if you have a monetary shock, which is an increase in yields that is driven by, for example, inflation picking up more rapidly, which is not the case right now, then you have negative spillover effects in terms of faster asset price corrections and negative income effects dominating. So that's the first mitigating factor. The US economy is doing better, so overall the spillovers should be positive. Now, a second mitigating factor is the fact that in all likelihood interest rate will not go back to pre-crisis levels. On the left here, you have the FOMC forecast from September. This is going to be revised on Wednesday, but shows that both real and nominal interest rates will stay significantly below pre-crisis levels, certainly over the next 2 years, but also over the medium term. So rates will rise, but more slowly than we've seen in the past. So the first 2 years of a tightening cycle typically saw interest rates rising by 330 basis points. The FOMC expects this rise to be around 200 basis points, and the market expects rates to rise by 150 basis points, which is very, very slow. Probably the discrepancy between the market and the Fed is a cause for concern, and we'll have to see how this is. Whether the Fed will catch up with the market or market with the Fed in 2016. This is going to be a pretty interesting development. But overall, rates will stay low, and they will also stay low because monetary policy accommodation in the rest of the world, particularly in Japan and the euro area, balance sheets of those central banks continue to rise, and they will continue to rise significantly over the next 2 years. Even the balance sheet of the Fed will not shrink significantly. Interest rates in many European countries is negative, and the ECB has decided to bring it even more negative a few weeks back. So, I mean, overall, if you look at the environment from an advanced economy perspective, the hike this week will take place against the backdrop of a relatively robust US economy, further accommodation in other advanced economies. So this should overall alleviate the impact on emerging markets from a real economy perspective. So the second question is, how have conditions evolved for emerging markets themselves? And there, of course, there are few sources of concern. Emerging markets and developing countries collectively will see their weakest growth this year since the global financial crisis. And you see this significant rotation in credit risk from advanced to emerging economies, especially this year. So the relative credit worthiness of emerging markets has deteriorated together with growth, and that growth slowdown is related to both structural, cyclical factor, external and domestic factor, and it will not reverse very quickly. An external factor, you have the drop in commodity prices. This has accelerated even in recent days. You have weak trade and the spillovers from the rebalancing in China, which is quite significant. And then you have capital flows, which have decelerated quite a bit. So these are external headwinds. Domestically, productivity has slowed, leverage has increased in recent years. Fiscal buffers are much narrower. In some places, current account deficits are still a source of concern. So from a pull perspective, from a recipient of capital flows, the fundamentals for emerging markets have deteriorated quite a bit.
And the third question anticipates what the vulnerabilities are, right?
Yeah.
Yes.
So the macro vulnerabilities have not really diminished a lot since the taper tantrum. We've seen some adjustment in current accounts for oil importers because they have cheaper imports, and also for some because the domestic economy has been so weak that imports has been contracting. So from a purely external financing perspective, this has reduced somewhat vulnerabilities, but you still have a lot of currency exposures in some countries, and probably the greatest source of concern is the increase in corporate leverage that we've seen collectively for emerging markets. And this has been increasingly concentrated in sectors that are very cyclical, that have pretty weak balance sheets. And so as borrowing conditions tighten, these corporations' balance sheet could start deteriorating pretty quickly. Not necessarily for commodity exporting, commodity producing companies because they have revenues in dollar, but more those that are domestically oriented, construction, cement, and they've borrowed in dollar but have revenues in currencies that are depreciating. And the balance sheet of those corporations could deteriorate and also deteriorate the balance sheet of banks and lead to greater concerns in terms of financial stability. So these I would say corporate leverage is probably the greatest source of concern right now.
I wanted to go back to one of the slides you had, but I don't know, is this the final slide you wanted to show, or do you have others?
Well,
He has 40 others. So.
I have another
Right.
3.
Okay.
Um,
Why don't we just go through the 3, and then I'll go back to that one slide.
All right. So what could go wrong? And that's obviously the question. Interest rates in the U.S., long-term interest rates are still at 2.1% today, which is very, very low. So they have let's say there is a lot of room for them to increase, and they could increase pretty rapidly. As I mentioned, there is this gap in expectations between the market and the FOMC. That could be a potential source of a rapid, sudden increase in the long-term yields. And then you have term premia, which are close to 0 now. They're historically close to 1 or even above. So you could potentially see markets adjusting pretty rapidly to any news that contradict their view of future interest rates, which are very, very benign. So if interest rates go up rapidly, that could have severe implications for capital flows to emerging markets. I mean, these are simulations showing that a 100 basis point increase in US long-term interest rate could reduce capital flows collectively for emerging and frontier markets by 35%, 1.6% of their combined GDP. So capital flows are very volatile, and sometimes they move that much. So that could be sort of a manageable impact. But at an individual country level, the more vulnerable countries could see sudden stops, and these sudden stops have significant economic costs. I mean, we see historically here a sudden stop in an typical emerging market is accompanied by a drop of GDP of 7% and a drop of investment of 21%. So that could lead to severe economic consequences for these countries. And if the country is big enough, you could have spillover effects on emerging markets more broadly and increase risk aversion on global financial markets. So these are considerations that policymakers in emerging markets should have in mind while considering their policy choice.
Okay, good. Thanks, Marc. The vulnerabilities is a good segue for some observations I have on Korea. But before I get there, I actually wanted to ask if you could go back to the two shocks, the real and the monetary shock, and the effect of, I guess, the positive shock and the negative shock. Yeah, that's it. Are these are the real shock calculations? Are they based on the projection that the U.S. recovery from the crisis is relatively subdued, or is this idealized based on historical shocks, excluding the current experience?
So this is
In other words,
purely
is it overstated,
historical.
the positive effects?
It's not a simulation. It's purely historical. So it's trying to split events, whether there are they see an interest rate increase together with stock market returns improving, or whether yields increase while stock markets drop. So it's a purely decomposition of financial market movements and how they've subsequently been reflected in emerging market assets.
And can you tell how much foreign exchange rate effects there are in this relationship?
Yeah, so we have similar decomposition for exchange rate, and you see that the exchange rate effects, or the strengthening of the dollar, is much less significant when it is driven by a positive real economic shock. So currencies in emerging markets depreciate much less when you have a positive real shock than when you have a sort of a negative monetary shock, let's say.
Okay, good.
Tom, there's something brewing in the midst of all of this that complicates it even more, and that is the crash in commodity prices and in oil prices. One of the casualties of that crash are a huge segment of American manufacturers that are actively involved in making equipment for mining and exploration, and I can go back to my old congressional district where the largest county had a 25% manufacturing base, and you can go from industry to industry, and this really is not tied in. It's something that's totally separate. It's two different worlds that are moving at about the same time, and it's what you gave is a good perspective, and it's easy to understand. But I'm sure you agree that on top of all of it, where does this price and energy fit into the whole issue of the Fed raising interest rates, or does it?
Oh, that's a
Well,
good
you're
question.
supposed to ask the questions.
Well,
sorry about that.
That's a very good question. I think you're anticipating the third session we have. Maybe we'll do that one down in Washington, and we'll have a fourth one back up. Well, let me I'll try. We have several more minutes for our presentation before we move to Q&A. Let me turn to how this ties in with Korea. Okay. So this is the policy statement made on Thursday, I guess, December 10th was Thursday, from the Bank of Korea. Bank of Korea remained on hold at 1.5%, their base rate. And what they're saying, this is extracted from a longer statement, is that the Bank of Korea sees that Korea is already being influenced by this anticipated liftoff by the Fed, saying that stock prices have fallen. Long-term market interest rates are rising. And then there's been exchange rate effects as well. And then the Bank of Korea always sums up its policy statement by iterating the risks. And the first risk, of course, here is that it's the Fed monetary policy. Second risk that they mentioned is basically China, but also other emerging markets that are softening, in large part because of what Don is saying. Emerging markets are largely a commodity play. And so we see this with many export markets for Korea are softening because of the decline in commodity prices, particularly oil prices. And then the Bank of Korea also cites adverse movements with capital flows, and then they've been concerned about the trend increases in household debt for a long time. This is nothing new here. The Bank of Korea is pretty vigilant on monitoring risks to the Korean financial system. I believe since 2005 they've been publishing financial stability reports twice on a quarterly basis, I believe. And so these are the risks. You'll have to excuse my poor PowerPoint skills, but it's kind of hazy, fuzzy. But the biggest risk over the short term, of course, is the U.S. interest rate normalization, and over the medium term, it's China, persistent low economic growth and low inflation in Korea, and household debt, according to the Bank of Korea. Now, turning to the Fed policy rate hike and the slowing Chinese economy, what will this mean on financial stability in Korea? Well, actually, a slowing Chinese economy has a somewhat greater effect on the capital buffer that Korean banks have built up since certainly since the '97 crisis, but also since the 2008 crisis. The slowing Chinese economy will have a slightly greater effect on reducing the capital buffer than a Fed policy rate hike. So if we're expecting the Fed to increase interest rates by accumulation of 100 basis points over the next year or so, what this means is that the BIS ratio, capital ratio, is still a very strong 13.9% in the case of Korea. So at least from the banking channel, little adverse effect on Korea. In terms of government bond yields, well, this is how they stood on December 11th, and by and large, Korea and the U.S. the yields are very close. Actually, on December 10th, Korea's was slightly tighter than the U.S. 10-year bond yield. China is higher. I throw in China in because I just like to benchmark whatever goes on in Korea with China, as well as some advanced economy as well. So Korea has probably starting to see some effect on KTB rates from an anticipated liftoff. Now, that's not always the case. There always hasn't been a one-on-one convergence, at least going back to the taper tantrum back in 2013, when actually U.S. rates caught up to converge with Korean rates at that time, KTB rates. And there's been, at the beginning of this year, there was also a period of where the rates diverged, but now they've converged again. Rather, this is somewhat hard to see, but it seems like Korean Treasury rates are closely correlated to the Bank of Korea base rate. So the monetary conditions internally in Korea have a great effect on at least government interest rates in Korea. Now, what would happen in terms of capital outflows? Well, what happened during the taper tantrum back in July is that there were net outflows from stock funds, but back then bond funds, foreign investors continued to purchase in there. And then subsequent to that, there's been a huge buildup in securities, or a sizable buildup. I don't know if I want to call that huge, but a sizable buildup in inflows into Korea. Again, probably reflecting relatively good fundamentals in Korea compared with the rest of the world, at least. Turning to financial stability again. So this is the Bank of Korea's financial stability index, and the most recent one was published for earlier this year. I think in the next month or so, there will be an update of this, but It looks like Korea is it's a blue line. It's under the the green dotted line, which means it's below the warning stage. So Korea is in the financial system that is a relatively favorable position to handle whatever complications or adverse effects come from the Fed liftoff. And turning to the components of the financial stability map, we see that bank soundness is strong. Non-bank financial institution soundness is relatively strong. Even stronger is foreign exchange soundness. I'll get to that. And overall financial market stability. The weak points are corporate indebtedness and household indebtedness. Okay, now why is the foreign exchange soundness so sound? Well, Korea has now a net international investment position. So in 2014, Korea transitioned from being a net borrower from the rest of the world to a net creditor. In fact, that has continued to increase through the third quarter of this year, and you can see that line there. I believe in 2014, at the end of the year, as a share of GDP, it was something close to 5%. I'd have to double check that number of GDP, the net IIP. So now it's probably about double that, or close to that. Fairly substantial cushion buffer to financial market vulnerability. And if you turn to one of the components of the net international investment position, the IIP, of course, is the balance sheet of the entire country, the central bank, the government, and the private sector, individuals as well, vis-a-vis the rest of the world, and likewise vis-a-vis Korea. You see, in terms of the debt and the financial assets, and not the equity holdings, that there's been a buildup in external assets held abroad. Some of it actually recently is from the National Pension Fund, a diversification of its portfolio into foreign assets. But Korea, by and large, I think there's been pretty good macroprudential regulation because in recent years, well, since the Fed easing, there's been a very little buildup in external debt. So Korea, I think the regulators learned the lessons of 2008 and 1997. They didn't become complacent and didn't take it for granted that the debt would always be available. So what Marc said, the vulnerability to a sudden stop in credit is pretty low in the case of Korea. I really didn't want to go into this, but this is it. This is what the IMF shows the growth outlooks for various economies. So the IMF thinks the U.S. This is done in October, that the U.S. growth will continue to accelerate. So perhaps we'll get a beneficial real shock from the Fed liftoff. But I'd like to thank my fellow panelists coming up from Washington D.C. to join us here in New York, and also thank you all for coming and taking the time out from your day to come to the Korea Society. Thanks.
Thanks, Tom.
Thank you.